Youssef, you've got a buy on Lyft, I believe, and with all of the, I guess, hand-wringing to some degree over what might happen today, what can we tell so far from today's action?
I don't think you can say a whole lot other than if you're a shareholder and you've participated in different series, even on the private side, you're still above water. I think the last round, I think it was the I round done in June of last year. I think it was done about 20% below where it's trading right now. And I would say that the last earnings call really gave all the shareholders, but particularly the private ones, a reason to continue to believe in the story because, one, the company showed a much better top line as a reflection of just a better competitive environment with Uber domestically. And the other is a much better cost containment, which to Deidre's point is clearly kind of a back or a first step towards profitability. And one of the big concerns that we hear from many investors is they don't know when this company and Uber are going to turn profitable. Is it 2022? Is it 2023, et cetera? And I think the earnings they put up tell you that they're more likely than not to turn profitable earlier than what the street thinks.
Tom, since Uber went public, I'm looking at the charts, these two stocks have been like synchronized swimmers for the most part. That continues today. I was watching it, and does that change? And given that, what's an investor to do?
Yeah, it's funny. We were looking at the current trading multiples for both stocks this morning, and their multiples are effectively the same. Now, the pitch for Uber and kind of the bulls on Uber is that because Uber is the scale player and because they will have synergies by offering multi-products, Uber Eats and ride sharing, that they'll get to sort of a higher margin kind of at a steady state or normalized basis. And so I think that's one side of the argument. The other side of the argument is that, Lyft, doesn't have multi-products on the platform. Yeah, it's going to be sort of a second-tier player, but it's growing more quickly. It's gaining share, and sort of that kind of fight between this long-term margin potential for Uber versus the kind of smaller, more nimble share gainer, I think is going to kind of determine kind of which stock trades at a premium.
You surprised to see Lyft shares up 1% with a lockup expiration today?
Yeah, I am. I was expecting sort of girding myself for sort of a down day. I think it reflects, Deirdre touched on it in the run-up. This company's been private for a very long time. I think the early kind of pure VC investors who hold shares, they're sellers at any price, basically. And I think, the average trading volume for Lyft shares is around 3.5 million shares a day. We're clearly seeing some selling, I think, from those pure VCs. But Lyft raised a lot of money from kind of other more traditional investors, mutual funds, other types of asset managers who might be less inclined to sell with the stock down.
That's a key point right there, Youssef. The fact that you are talking about whether it's Lyft today, which, 7-year-old company, or Uber probably later this year, which is even older. You have a number of these companies that went public this year that were already so mature, a lot of angst built up around what these lockup expirations could look like because of that. How does Lyft basically set the stage for what more of these expirations could look like?
I think it really boils down to the fundamentals of the business and whether there is a reason to hold on for longer. To the earlier question around, do early investors with an average cost of $1 or below are more incentivized to sell? Of course, but I think we're talking about now a multi-billion-dollar company that has arguably a long runway ahead of it. And to the extent that the top line remains or has the potential of continuing to outperform expectations with a path to profitability that is shorter than what most people think, I think these companies will continue to perform. We recently did a proprietary survey on the ride-sharing business that basically showed that less of all the people that were surveyed have ever tried a ride-sharing service, and among those, less than 40 have actually tried it once a month. At the same time, you have people that literally take these services multiple times a week. And so I think the runway for growth from both frequency of rides and the total number of riders continue to be pretty high. So we remain pretty positive actually on both.
We had talked about a return to price rationality after they came public. Now they have. Is that being borne out in real numbers? Is it less promotional?
It certainly seems to be less promotional. Lyft, for example, their sales and marketing line declined 4% year over year in the second quarter. Now, that's not the only line in the P&L where some of the incentives and promotional stuff shows up, but they grew revenue 72% and were able to decline their sales and marketing. So we're starting to see it. I think it's a good thing, obviously, but in the background you've got other sort of potential shocks which could cause other disruptions in the business. So like AB5, for example, this law in California, which may get codified into law. You've got cities like New York putting caps on. That may require kind of Uber and Lyft to kind of raise prices, which will kind of bite into their profitability potentially if it has an negative impact on ridership. But yeah, so far that market rationalization is playing out.